So I want to really first start with passive real estate because that's what we do. So talk to me, everyone says that real estate, passive real estate specifically is tax advantaged, benefits of taxes. But what does that mean? What tax implications, expectations will I actually get? And how do I benefit as a physician by investing in these types of deals?
I think that there are two sides to this question. There's number one, the investor side. Like you're first and foremost before you're regardless if you're a physician or not, you're an investor. You have capital, you want the money to work for you. Specifically because you're a physician, you don't have a lot of time to do it yourself, and that's why you're in the first place. You're looking for something that is a bit more passive. Give the money to somebody that you trust, and then get the returns every year. Um, that's the investor side. The other side, when it comes to taxes, it really depends what you invest in. But I will let Rachel maybe describe a bit more about the tax side of that.
Yeah. From the tech side and specifically for passive real estate investments, when you're first investing in a deal, you're making that investment. So the investment itself is not a tax deduction. But where you get tax deductions is throughout the life of the investment or the deal. So when you first make the investment, you contribute capital, that creates something called your basis. And that's what's going to drive whether or not you can take losses, what your gain or loss will be when you sell the investment. And then throughout the life, based on how, if you have income or loss, that's going to be taxed at your ordinary income rate. And then there are special things that happen with losses. So usually when you're first investing in something, depreciation is something that you'll hear about a lot. You can get this big bonus depreciation deduction, or you're getting this huge loss in the first year. Because it's a passive investment, that could be true, or that loss could be limited. Everything really drives on your personal situation. So there are a couple ways that it can go. On the one side, if you just have the one investment, and you have a passive loss, that loss might be carried forward to offset future gains. And if you have other investments, so you have maybe investments that are generating profits now, they're doing pretty well. In that case, you can use the loss from your new investment to offset those other investments. But all of your passive investments are going to be pulled together, and the losses can offset each other. At the very beginning, there's not going to be an offset to, say, your W-2 income unless you have a super specific situation, like you're a real estate professional, or you're really involved in the investment.
In the first year from an investment, most people will not see a reduction in their taxes, right? They will basically have a paper loss, which comes from depreciation because the government considers an investment in a physical object, something that depreciates over time. The way I like to explain it to people is think of a car. You drive it off the dealership and you lose 20% value, right? The government says the same thing happens to everything else. It's just for the most part, not always, but for the most part, real estate appreciates in value. So you're able to use that. So say you put a $50,000 investment, you might have on paper like a $30,000 loss. Now, when you first start investing, you're like, wow, great. I can reduce my taxes by 30,000. Well, that's not true because your income, most physician income is considered active. And then the losses you have are passive losses. Now, we'll get into maybe a little bit later on how to try to convert some of your active income into passive. But for the most part, active income's active and you can't subtract your passive losses against it. So to think about this in the very beginning, first year you make the investment, you have a lot of losses, it looks great on paper, but your taxes are going to be the exact same between the years, and it's not going to be adjusted because of that investment. Does that sound right, Rachel?
Yeah, exactly.
And just something to mention, like when
Mm-hmm.
you think about investments in general, I think about the tax side and the tax upside as the cherry on top.
Mm-hmm.
You make the investment in order to generate returns. If you have a tax benefit for that, that's not the main reason. Not in all cases, but in many cases, to make the investments. If it's a good investment, it generates great returns, and it has like the tax benefits because it kind of like fits into your bigger picture. That's the cherry on top. But it's not the main reason why you want to go to make an investment in most cases. Not every situation is different, but in most cases, that's the truth. So think about taxes as really the cherry on top and not really the reason why. And that's something that I think that some people are kind of like missing the points on that, especially if they start to invest, just start to invest basically.
Yeah, I mean, you're not telling people to spend $5,000 on their CPA to save $1,000 on their taxes.
No, no, because you still spend like $4,000 even if you save like the
Yeah.
1,000.
Yeah. Especially physicians, we tend to think about taxes a lot, and often get into things for the tax benefits that end up hurting us in the long run. For example, I knew a lady that had a property in Newport. It appreciated from 500 to 2 million. Anyone that knows Newport knows it's a very nice area. Did a 1031 of the whole $2 million. And now every couple of years she has to find a new 1031, and she's just getting eaten up by fees and just having a lot of difficulty finding deals that meet the criteria to be able to invest. So she's kind of in a cycle of having to do that. And, yeah, it would have been a lot of taxes to pay when she first did it, but had she done that, it would have just been a lot less headache. So a lot of people think so much about the taxes that they end up hurting themselves in the long run.
And I know it sounds funny when we say that as as a tax company that it's the cherry on top, but not the reason. But that's the truth. And anybody who is really trying to push it as a sales point, and that's the main thing that they are trying to push, that's something definitely to be a little bit more careful. Focus on
Mhm.
the returns on the investments, then you ask about the taxes. That's a good just like framework when you evaluate honestly any investment, but it's extremely important when you're talking about alternative investments and real estate, even before anything else.
Yeah, and so also to kind of close up the first year, people will talk about bonus depreciation and cost segregation. Rachel, if you could just talk briefly about what those are and why that helps front load your losses.
Yeah, so bonus depreciation and cost segregations, they're both ways where you can get more of that depreciation taken up front. So for example, if you buy a typical residential rental property that's depreciated over 27 and a half years. But if you allocate certain pieces of that property to, say, instead of saying all of it's a building, you say, this much is, cabinets and non-structural things, those can be depreciated faster where you get a bigger upfront deduction. If you're, it's not your first investment and you do have other passive income that you're looking to offset, or other ways that you can leverage those first year losses, having those big losses up front can be really beneficial for you.
And to my knowledge, those losses carry over indefinitely, right? So
Yeah.
for anyone, even if you have no idea what you're going to use it for, it's better to have it up front and not need it than need it and not have it.
Absolutely. You'll never lose it. And we can talk about what happens to those losses throughout the life cycle,
Hmm.
as we continue on.
And
Yeah.
it is important, assuming that like you carry them forward, assuming you write it down, assuming you need to report it every year, basically, and make sure that you record it properly
Hmm.
when it happens. And we see a lot of mistakes that somebody sometimes like missed it for 1 year or didn't include some of those losses. And that can be like you can fix it. It's not like a super big deal. It's not like the money is gone a lot of the times, but it requires like you need to fix it and you need to do something. So it's really important to do things the right way from the get-go. It will just save you lower your chances to have like headache later on. So that's something important to keep in mind when it comes to losses and carry forwards in general.
Yeah,
Yeah.
awesome. Good.
Just to add to that, one of the things that we like to do is we always like to look at prior year returns to see if there are opportunities for refunds, especially if people are switching tax preparers year over year and you have those losses. It's super important because it's something that's not affecting your actual tax return. It's just a carry forward. It's really important to make sure that those are tracked year over year so that you don't, it doesn't get lost and you don't lose that benefit.
So, because of bonus depreciation and cost segregation, you get to use or get 30 to 50% of your investment. Was a little higher before, actually. One of my investments many years ago, when there was 100% bonus depreciation, I got 114% of
Wow.
my. Yeah, yeah, it was crazy. Uh, but it's been going down now with the new administration. They're talking about bringing it back to 100, but it's not happened. So it's
It's
gone from
actually in the
100
Senate.
the
It
Senate.
passed. It passed already the House. The bill
Yeah.
already passed the House like last year, like during the year.
Hmm.
And because it's an election year, I think that probably the Republicans didn't want to give a tax win to the Democrats during election
Yeah.
year. But it's right now. It's sitting in the Senate. So
Mm.
it's passed the House. It's already in the Senate. They just need to bring it to a vote, but they didn't do it yet.
Awesome. So getting closer to being done. So then will give you an extra 20% or potentially 40%, right? Because right now it's 60% into the year, it'll be 40%. So it'll be a large increase. So
Yeah.
you're getting say 30 to 50% of your initial investment. So say you put in 50,000, you'll get anywhere from say 25 to 30,000 in the first year. What happens? Do you get more depreciation after that, Rachel? Like, how does that work?
Yeah, you continue to get depreciation for, up to 27, sometimes even 39 years. Just that first year that you're putting something in service is usually where you can get the most out of it. And then the remaining whatever hasn't been depreciated up front continues to go over time.